Okay, let's start with topic 55. In this topic, you're not going to learn anything new. It's going to be just revising whatever techniques we have learned. Every problem you may have to do forward contract, money market hedge, option contract, futures contract, or leaving it as open, netting, currency invoicing, anything can come in any of the questions. So we are just going to revise all the techniques from the beginning. I'm not going to do, you're not going to learn most of the questions. There will not be a new learning. It's just kind of revising again and again the same set of techniques. Let's do question number 1. XYZ Limited, all of these are exam questions which would have been for 8 to 12 marks, anywhere in between. XYZ Limited, a US firm, will need 3 lakh GBP in 180 days. In this connection, following information is available: spot rate, forward rate, 180-day deposit rate, 180-day borrowing rate. Call option has an exercise price of 1.97, premium of 0.04. XYZ Limited has forecasted the spot rates 180 days, hence as follows. Which of the following strategies would be most preferable? Forward contract, money market hedge, option contract, no hedging. Please go through this. Okay, let's start evaluating each of the option. Working note 1, calculation of outflow under forward contract. Calculation of outflow under forward contract. Outflow under forward contract. Outflow under forward contract known equal to, what's a known component? 3 lakh GBP. Unknown equal to question mark USD. USD is equal to GBP into USD per GBP. We don't have bid and ask rate and all. We just need to use the USD per GBP 180-day forward rate. Whatever is the forward rate, USD per GBP multiply. If it's GB per USD, do 1 divided by the rate. 3 lakh into, what is the rate given? 1.96 is what? USD per GBP? USD per GBP into 1.96. USD 5 lakh. This will be the outflow if I go with a forward contract. The first option is a forward contract which will give me an outflow of 5,88,000. Any doubts on 5,88,000? First option will give me an outflow of 5,88,000. What's the second option they are talking about? Money market hedge. Working note 2, calculation of outflow under MMH. Calculation of outflow under MMH under money market hedge. Step 1, exposure equal to receivable or payable? XYZ Limited, a US firm, will need GBP 3 lakh. Will need means they need to pay somewhere. So payable of GBP 3 lakhs in 180 days. Payable of GBP 3 lakhs in 180 days. Step 2. Identification of, we have an asset or a liability? Liability. Identification of GBP deposit to be created. Identification of GBP deposit to be created. GBP deposit equal to 3 lakh divided by, what is the GBP rate? Now listen, if unless specified otherwise, that's a per year rate only. They have to clearly mention 4.5% per 6 months. 180 days deposit rate doesn't mean it's a 4.5% for a period of 180 days. You go to a bank and ask what is a 7-day FD rate, they'll say 7%. That doesn't mean for a period of 7 days they'll pay you 7%. That's a yearly rate. So this 4.5%, 5%, 5%, 5.5%, all these are per year rate. All these rates given in the question is for a year. So you'll have to appropriately consider this. So I'm going to create a deposit in GBP. What is the deposit rate in GBP? 4 points. So 1 plus 4.5% by 2. 1 plus 4.5% by 2. Be very careful as far as your interest rates are concerned. Interest rates are always for a year. 3 lakh divided by 1.0. So it is 2,93,000 GBP 2,93,398.53. I need to create a deposit of this number 2,93,398.53. Any doubts on this? We have done money market hedge today, so the same thing we continue here. Step 3. Calculation of loan to be taken in USD. Loan in USD equal to GBP 293,398.53 into what is the spot rate? You'll have to take care of division multiplication. I hope there are no confusions there. Into 2, which will be USD 5 lakh. Okay, 797.06. USD 5,86,797.06. I need to take a loan of that much. USD 5,86,797.06. Step 4. Take USD loan. Take USD loan. Convert into GBP. And create deposit. Take USD loan, convert into GBP and create deposit. Take USD loan, convert into GBP and create deposit. I'll have to create a deposit. Step 5. Step 5 is you will pay this 3 lakh GBP by the receipts which are going to come. Pay 3 lakh GBP with GBP deposit maturity. Pay 3 lakh GBP with GBP deposit maturity. I'm not explaining in detail. I've done this 4th or the 5th time today, so should be clear to you guys. Pay 3 lakh GBP with GBP deposit maturity. And what will be step 6? Loan repayment along with interest. That's your entire outflow as such. Step 6. Loan repayment along with interest. We took a loan in US dollars, so that repayment has to be done now. We took a loan of 5 lakh 586,797.06 plus the interest rate in USA is how much? 5.5% plus 2.75 percentage. 5.5 percentage is for a year plus 2.75 percentage. 586,797.06 USD 6 lakh 2,000. Any doubts on 6,02,933.98? Any doubts on this? Clear? Any doubts on 6,02,000? So first forward contract we were paying 5,88,000. Money market hedge we pay 6,02,933.98. Any doubts on this? What is the third option? Working note 3. Outflow under option contract. Now, listen, what can an option contract do? It can provide you a maximum cap. It may not be in a position to do what can be the outflow because it just provides you a maximum cap. But in this question, I do not go with the maximum cap. They have said that the possible price can be 1.91, which has a some 25% chance. You also it can be 1.95, which has a 60% chance, and there is 2.05, which is a 15% chance. If I just go by maximum limit is 1.97 and a premium of 0.04. So my maximum outflow is going to be, ideally I should consider some interest on this premium. Institute has ignored it in this problem. I'll tell you which type of problem they normally consider. In these type of problem they ignore it. Wherever there are specific interest rates given, they do consider it. If you consider interest on it, is it right or wrong? Perfectly right, you can consider interest on it because premium is going to be paid on day 0. They have ignored in this problem, so I continue to with whatever treatment Institute has given. So if I just go by maximum cap, maximum is this 2.01. Can it be lower? Yes, it can be lower if it's 1.91. Can it be lower? Yes, if it can be lower if it's 1.95. If it's 2.05, I'll get the restriction up to 2.01. It can give me only a maximum limit. The maximum limit is 1.97 plus 0.04. But wherever the exchange rates are lower, there is a possibility that my outflow can be lower. So now have 3 columns. 3 columns. Spot rate, I think you will require 4 columns. Spot rate, let's capture the spot rate given. USD 1.91, USD 1.95, USD 2.05. Outflow in call option. Outflow in call option. Strike rate given for the option contract 1.97. If the price is more than 1.97, I will bring this into picture and pay only 1.97 plus the premium. If it's less, let me pay whatever is the market price. Premium is how much? Now listen, in this case I will be paying 1.95. I don't want to pay 1.97 plus premium. What is the point of paying 1.97 when in the market it's only 1.91? In this case I will pay USD 1.99. Why 1.99? 1.95 plus premium. In 2.05 I will pay only USD 1.97 plus the premium, and I will pay only 2.01. In first scenario and second scenario I will pay 1.95 and 1.99, but in the third scenario I will take the help of my option contract and pay 1.97. In fact, we could have done it like this also. Everywhere we could have written USD 1.91, USD 1.95, and this place USD 1.97, and finally add 0.04 to the weighted average, because premium will be paid in any scenario. Premium is not going to be avoided, be it scenario 1, scenario 2 or scenario 3. So either you ignore the premium for the time being and finally add on top of it, or consider whatever. Let's consider premium at every level. Write that. Outflow in call option 1.95, 1.99 and 2.01. 1.95, 1.99, 2.01. Then probability. There's a probability of all of these things happening. What is the probability of 1.91? 0.25. There's a probability of 0.25, 0.60 and 0.15. See, a call option gives you a maximum restriction. Maximum is 2.01. Can it be lower? Yes, it can be lower in scenario 1. It can also be lower in scenario 2. But in scenario 3, it will put a restriction of 2.01. And they are giving probabilities attached with it, so I cannot ignore them. Till now, none of the problem used to give us probability, and we used to say maximum limit is so much. Here, I need not give the maximum limit. I can give what is the expected outflow. Expected outflow means using probabilities into consideration. Do the product and tell me the figures. Product 1.95. Wherever probabilities are there, you will have to bring that into picture and multiply. Maximum outflow is 2.01, but realistically our outflow is 1.983. Maximum is 2.01, but considering the rates given, we will have an outflow of 1.983. If these rates were not given, we would have written it as 2.01 and done the analysis. 2.01 is what we would have analyzed it as and said that this is the maximum cap. But then I cannot do any comparison with the other set of numbers because they are giving the realistic outflow and this is giving a maximum. So instead of getting the maximum one, the realistic outflow is 1.983 USD per GBP. Any doubts on this? Any doubts on this part? Clear? Can we proceed? Then below that, right, outflow in USD equal to outflow in USD equal to 1.983 into 3 lakhs. 1.983 into 3 lakhs. $1.983 into 3 lakhs, which is 594,900. 5,94,900. Any doubts on this? Now think about what will happen if you don't do hedging and tell me the answer. Scenario 4, no hedging. So what is the spot rate? If you don't do hedging, it will be spot rate. What is the spot rate? Yeah, 1.91 into 25%. As indicated, it will have to do the weighted average of the various expected rates. You had made certain expectations, so you will have to do a weighted average of that. When I would have taken the real spot rate, if they had given me, I would have taken that. But on day one, see, which of the following strategy would be most preferable to XYZ Limited has to be on day one. I cannot go to day 180 and say, okay, best strategy is to do no hedging, because you will know the scenario there. Now today what I say as the best strategy in reality may turn out to be even the worst strategy, because the currency movements can be opposite of what you expect. It can change in any direction, your expectation or something, and it changes a little differently. Your hedging strategy, which look like to be the best one on day 0, can turn out to be even worst. So that is something which is beyond our control. On day 1, I am saying forward contract 100% 5,88,000. There are no changes on that. Money market 100%, it is going to be what number we had? 6,02,933. Option you cannot say with 100%. Option 594,900 is what you say today. But if currency movements happen on the negative side, it can even be 2.01 into, this is the max, this can't go beyond this. But today's expectation is 594,900. It can be above 594,900 also. Any doubts on this? So outflow in USD was 594,900 for option contract. Next, working note 4, no hedging scenario. No hedging scenario. Now, right, in a no hedging scenario, the company has to, compute the expected spot rate, and based on that, we will get expected realization. Based on that, we will get expected realization. Three columns: spot rate, probability, product. Spot rate, probability, product. What is the outflow with no hedging? 5 lakhs. 586, 500. Which is the best option? No hedging. Whatever gives the lowest one. Whatever gives the lowest one, that will be the final answer. So the company has to opt for no hedging strategy considering their expectation. Whatever expectation they have given, based on that it makes sense not to hedge. But yeah, there is obviously an element of risk in this. Because if it was answer forward contract, then there is no risk in it. If the answer was a money market hedge, no risk. Options will have still a risk, and no hedging obviously has a risk. Because anything can happen. It can even turn out to be 2.05. It can even turn out to be 2.05. In that case, our outflow will become 6,15,000. The expectation is that on an average it will turn out to be 1.955. The expectation is on an average it's going to be 1.955. But if it turns out to be 2.05, there's a huge loss. Any doubts in this? You can write a conclusion. The company should go ahead with a no hedging. The company should go ahead with no hedging. Should go ahead with no hedging. As the overall outflow is the lowest in that scenario. As the overall outflow is the lowest in that scenario. Go through question 4, start doing it. I'll take you through only currency option. There alone I'll take you through. Forward, money market, you do it. Question number 4. Go through question number 4 and start doing forward and money market. I'll take you through currency option alone. Take your time, do the forward and money market cover. Forward contract and money market, please do it. Start doing it. You will not see any challenges in those. This was in your forward contract, GBP 236,102.88. I saw most of the notebooks this being correct. Some notebooks you had an issue of bid and ask analysis, so don't try to skip a step. If you try to skip a step, you will make a mistake. It's okay to spend a little bit more time unless you are extremely confident. Extremely confident, go ahead and do it. Otherwise, don't try to skip a step. It's okay to write known component, unknown component, deriving at the formula, seeing what's the denominator, bid, ask, all that step by step. It's perfectly fine. It will take you a little more time, but can't help it. In this chapter, there's no option at all. We have to create a USD deposit of 3,56,867. That will mature to 364,897. We need to create a deposit of 356,867.48. I have not created the deposit. I need to create so much of a deposit. 356,867. Any doubts in that number? 1 plus 4.5% by 2. In US, the deposit will be created at the rate of 4.5%. Then when I convert this into GBP, it's a little tricky part here. Known USD, I need a requirement of 356,867.48. This is what I need on day 0. 356,867. To get this, I will go and take a loan in GBP in the bank. So GBP is equal to USD into GBP by USD. I need to buy US dollars. So I will first take a GBP loan. I don't know the amount, that's what I'm calculating. After taking that loan, I'll go to the bank and say, okay, boss, take the GBP and give me dollars. Once I take the dollars, I'll go to the other bank and create a deposit. So I'm going to buy dollars. Bank is going to sell dollars and bank will sell at ask rate. 356,867.48 into ask GBP per USD. 1 divided by 1.5617. 1 divided by 1.5617. This is the loan you have to take on day 0. I've told you, we have repeatedly done this calculation. We have to take this amount of loan on day 0. After taking the loan, you will do the conversion. After doing the conversion, you will create the deposit. All of that is going to happen. First, we are doing the calculation. What loan is needed? That number is divided by this is the amount of loan I'll take, 228,512.19. 228,512.19. In step 4, take loan, convert into GBP and convert into USD and create deposit. This is more of a formality. Take a loan. You first identify what loan to take. That loan is 228512.19. 228512.19 is the amount of loan to be taken. Be extremely careful about bid and ask rate. 228512.19 is the amount of loan to be taken. Any doubts on that? 228512.19. Then point number 5, redeem deposit and pay supplier. Whomever I have to pay, I'll redeem the deposit and pay that person, because the deposit will mature to 364,897. I'll pay whoever person I needs to pay this amount, that will go. Repay loan along with interest. In UK, the interest rates are 7%. Repay loan along with interest. We have done money market hedge multiple times. Let me know in case still there is a doubt. In case there is a doubt, I want to focus more on the last one, which is your currency option. My focus will be on the currency option part. Let's quickly complete this. Any doubts on this? Working note 1, working note 2, no new adjustment. I have not explained anything new there. It is what we have been doing in all the questions till now. Any doubts on this? Let's quickly analyze the currency option part. Now come down, working note 3. Currency option. Currency option. Let's capture the basic information. Exposure. Exposure. USD 364,897. USD 364,897. Contract size. What is the contract size given? GBP 12,500. Contract rate. What's the strike price they have given? 1.70 per GBP. Now, I will not be in a position to get the number of contracts straight away, because this is USD and the other one is GBP. So, OR divide by 1.70. GBP 2,14,645. Okay, 2,14,645. That's the number. GBP 2,14,645. Any doubts on this? Now come down, number of contracts. 214,645 divided by 12,500. 214,645 divided by 12,500. 17 point what number you get? 17, rounded off to 17 contracts. So I'm not hedging it fully. Some portion is going to be unhedged. What needs to be done for unhedged we'll see in some time. 17 contracts. Okay, now comes the most important part. The contract is GBP 12,500 and it can give me the right to buy or sell GBP at the rate of USD 1.7 per GBP. I can have a right to buy through a call option. I can have a right to sell through a put option. Both are there in the question. What can I do is I can buy or sell GBP at the rate of USD 1.70 per GBP. That's what the question says. You can buy or sell GBP, because we have already done all the conversion which is needed. I can either buy or sell GBP at the rate of USD 1.70 per GBP. Now you think whether you want to buy GBP, sell GBP, and whether it's a call option or a put option. Do you want to buy GBP or sell GBP? First tell me, and then whether it's a call option or put option. Are you going to, which currency are you going to buy? USD, which means you are going to sell GBP, and for selling purpose which option is useful? Put option. Clear? Able to understand this? So finally I am going to buy 17 contracts of put option. I am going to buy 17 contracts of put option. Put is what is beneficial for me, because put only gives me the right to sell GBP. So I can sell GBP at the rate of whatever rate I have decided on. Clear? Any doubts on this? When I sell GBP, indirectly what I will get is I will buy USD. Indirectly I am going to buy USD. Clear? Any doubts on this? Now write the company should enter into 17 contracts of GBP 12,500. Should enter into 17 contracts of GBP 12,500. Full stop. It has to sell GBP. It has to sell GBP. It has to sell GBP, and hence it should enter into a put option. Any doubts on this? Okay, now listen for some time. When I calculate my outflow, now my overall requirement is I need 364,897. Hedged. What is hedged is 17 contracts of GBP 12,500 into USD 1.70. So many USD I can get, because I am going to sell at the rate of USD 1.70 per GBP. How much do I get? 3 lakh. To get this USD 361,250, you are going to pay GBP 17 into 12,500. How much? 17 into 12,500. 2 lakh. This is my one payment, okay? Though it says I am selling GBP, but technically I am paying GBP, because I have to have an outflow of GBP 2,12,500, and I will get USD 361,250. Can I get more? Yes. If the rate in the market is 1.8, 1.9, 2.1, if the rate is better, I will end up getting more, but I don't have information on that. So as of now, I assume that I'll at best get 1.7. Minimum I'll get 1.7. Anything more than that can happen. So I've already paid GBP 12,500. I've got USD 361,250. Beyond this, can I get more? Possibility exists, but I don't know. So as of now, on day 0, we assume you're not going to get anything more than this. Now, how much USD you require? 364. So unhedged. Can you tell me what is the balance portion? 364,897 minus 364. 3,000. This also, either I buy it at the spot rate on the date of maturity, because I need this currency. I need USD 3647. So either I buy at the spot rate on the date of maturity, or I could have entered into a forward contract for this on day 1, because on day 1 I knew that I'm not going to get 3, because we wanted 17.17 contract. That was the issue. If it was exact number, I would have fully hedged it. So this number assumed as hedged through forward contract. You have hedged it through forward contract. When you hedge it through forward contract, you are going to pay 3647 into 1 divided by, we had already written the rate, 1.5455. Wait for some time. What is this number? 23.75. 1, I will get 361,250 through the option contract by paying 212,500. Second, balance unhedged, I will get it through the forward contract. To do all of this, I have to pay premium. Premium was 17 contract into 12,500. What is the premium for the put option? 0. Can you multiply and tell me how much is this? 20. Is this premium US dollars or GBP? Okay, 20,400. Is this US dollars or GBP premium which you are paying? Premium is US dollars. This is paid on day 0. I'm going to convert this into GBP now. 2,400. Can you tell me what is the spot rate? How much is this? 1306. GBP 13062. Okay, these three are my outflow. One item which I am ignoring is interest on premium. I can also have an interest on premium. Instead, I have ignored in their analysis. So I end up writing 3 items. Listen, on day 0, you have to pay premium. Premium is 20,400 US dollars converted into GBP 13,062.69. But let you even after paying premium and all, you cover only USD 361,250, for which you will pay GBP 212,500. Unhedged portion, either you leave it as unhedged or you hedge it through forward contract. For this problem, we assume that it's hedged through forward contract, and I pay 235, you will put a total of all of this, and that's the overall outflow under option contract. Whichever gives us the lowest outflow, we are going to choose this. Any doubts on this? Any doubts on this part? I don't know the spot price on the date of maturity. We don't have the spot price, I think. On the date of maturity, you don't have the spot price. So you can go through the spot also if you have the price. Correct. No, so per contract, it is not per contract. It is USD 0.096 when they say it's per GBP. That 0.096 is per GBP. For that contract size is so. If you ask whether what is the premium is for, so every even when we did futures and options, what used to happen, there used to be a lot size. So the premium is per share into the lot size. So the premium is per GBP into the lot size. The lot size is 12,500. One contract has 12,500 GBP. Please present this and then tell me what is the overall outflow. Complete this. And whichever has the lowest, that is to be chosen. Yeah. Complete this. With that, we'll end today's session. Complete this part. Your overall requirement is 364,897. Option contract can give you 361,250. Why 361,250? Because 17 contract into 12,500 into 1.7, I can get only 361,250. Can I get more? Yes, possibility exists. But it all depends on whether you are getting whether the currency movement happens in that direction or not. So minimum you will get 361,250. Balance you hedge it through option contract. Sorry, balance you hedge it through forward contract. Next class, we are going to continue with comprehensive analysis. I would advise you guys to go through all the techniques. Predominantly, discussion will happen on forward, money market hedge and currency options. Predominant discussion will focus on these three. forward, money market hedge, and yeah, currency options as well as futures. Ideally, there should be interest on top of premium, but in institute problem it's not there, so I've ignored it. Complete it. We'll end with this then.